Um, Today I'm talking about the more the basics or big picture about the analyst part. So when you analyze the stocks or bonds, we can talking about especially stocks in a more style way or sector way. So today I'm talking about the more style way because um, during the previous videos I'm talking about the growth part to the value kind of things. Those are we talking about the style things. So back to basic again. So we talk about the investment. Always we need to take a risk, and as much as you take risk, we expecting return. So high risk, high return, right? And low risk, no return. But what we want always we want to you know low risk and high return. That's what we human we do, right? So the if it is easy, that's a good things, but very ideal, fantastic, but actually it's not easy to happen. So making sure the either you standing on that side or that side. So how we can do by balancing the percent of our portfolio. So in this in that the basic informations. So with the also the um, two things we can talk about investment world. One is stocks, the other one is a bond. So stocks more high risk, high return. Bond low risk, low return. But among the stock styles, when you see the market cap, the the size of the company, small, medium, large, and then the valuation, so expensive company or less expensive company, or uh, so depending on that, value, blend, growth. So Dow Jones is located here, which here means the valuation is a blend and market cap is large. And we're talking about QQQ, the Nasdaq 100 following ETF. That one is the valuation is growth and market cap is large, kind of way. And when you talk about the Russell 2000, Russell 2000 means the uh, small and medium company. So small and medium here, and then they are mixing of the the value blend growth stocks. So which means a blend location. And like ARKK, the ARK investors, that they are the more growth sections, but around this area. So which means a large, medium, small area. If you go to the more small and medium, you take more risk. So let me erase this again. So in this stock style, um, when you go to the more growth and more small, more risk. When you go to the value and then go to Raji, it's most how to say the less volatility and then focus on more a safe return, right? High risk, high return, and then the kind of low risk, low return. That's the way. So let's move to the bond style. So in bond style, it's the here is the duration, means the short term, medium term, long term. So it's the medium term is about the 7 to 10 year kind of way. So short term is below that. It's a kind of the it can be the daily to the month kind of way. Long term means the 20 years, 30 years kind of one. And the credit quality axis, the one is the non-investment grade, which means junk fund. investment grade means the good companies or U.S. Government bond. So in this way, okay, let's erase this. So in the bond world, the high risk means the go to long, right? And then when you go to the more non-investment grade, it's more risky. And then when you think about the more safe return, then it should be short and investment grade. It's like a very short-term U.S. bond. So that's we can talking about the bond style. So when you choose either stock market or bond market, and then how much you can take a risk, and then so depending on how much you take your risk, you can have expecting some kind of returns. So always the common mistake is we expecting return first, and then we think about the risk later. So that's why people making mistake, and then we're easy to fail in investment world. Always thinking about the risk first and return after that. So it's your risk is you can manage it. That means um, you can keep invest. Okay, that's all for today. Thank you. Love once more. Thank you twice.